invested like upfront and ongoing into the business. And also added to that would be retained earnings. That would be, we'll see, and this is a connection with the P&L statement, the profit and loss or income statement. So this other piece is retained earnings. Earnings is your profits. So to the extent that each year you make a profit and you keep it within the business, that's added to your owner's equity, in addition to the amount that owners invest in equity that they invest separately into the business. And again, the formula is assets minus liabilities. So you can see here we've got assets, total assets are 113,000, total liabilities are 58, right? So that means that their owner's equity for this hypothetical company is 55,000. I'll do a bunch of spoiler alerts here and mention a few things that I'll come back to and repeat again, because I just want to make sure that we cover it and that it's reinforced. So this 55,000 is their owner's equity. And I'll tell you that, and we'll see in a moment, that the 55,000, this is again after one full year. This is December 31st, 2019, after they've been in operation for just over a year. The 55,000 includes $40,000 in owner's equity. So the owners invested out of their pockets $40,000 up front as a startup. And then they retained profits of $15,000 from that first year. We'll see when we get to the P&L statement. So 40,000 initial investment plus 15,000 that they retained from profits gets them to the 55,000. All right. So again, components of owner's equity are, we have 1, A and B, which are variations of the same thing. The owner's equity or investment paid in capital. It could be a direct investment from the owner or owners, but common stock, issuing stock, is another owner investment vehicle, which is stock in the business. So 2 variations of the same thing. Initial owner's investment is one component of owner's equity, and again, the other component is retained earnings, profits. So here's the full picture, right, where we've got the assets minus the liabilities equals the owner's equity. Another way of looking at that is that the liabilities and owner's equity equals assets. The flip side of the same coin there. All right. So let me take a quick look at what will be, and I'll give you a copy, all of you a copy of this spreadsheet. We'll do a brief preview here for the same company, this hypothetical company, MFG Manufacturing. So we've got a balance sheet tab, we've got a P&L, and we've got a cash flow statement, 3 different tabs. And this balance sheet tab is pretty much what you've seen already, what we've covered as far as the components of their assets, short and long term, their liabilities, short and long term, and then there's owner's equity. And here's where we have to break down between that $40,000 of paid in capital, the original owner's investment, and the retained earnings, which is from their profits, to get to the 55. We'll see this paid in capital of $40,000 even more clearly in the cash flow statement when we get to that. So again, just trying to tie some of these statements together in terms of the relationships that they have with each other. All right, so that's the balance sheet. Let's go back to full screen. Let's do the P&L statement next. Right, so the P&L statement is also called the income statement, profit and loss statement, right? And it shows pretty much how much money that your company has made over a period of time. So this isn't stopping the clock. It's not a stock measurement. It's a flow measurement. And you can see here that it's January through December. It's the full year, from January 1st to December 31st is the profit and loss for this particular example, MFG Manufacturing Company, right? So, and it does include some non-cash expenses like depreciation. We'll get to that when we break it down further, right? So, and essentially it's pretty straightforward. It's going to be revenue, and we'll take these section by section, but revenue minus a couple different categories of expenses, equals your net profit. All right, so let's take a look at this first cut of the P&L statement of what's called gross profit. All right, and again, this is a manufacturing company. So the first cut is gross profit, or sometimes called gross margin, but it's sales. In this case, the company's sales for the full year, January through December 2019, is $350,000, and their cost of goods sold, okay, is $210,000, and that leaves them with a gross profit. That's your first cut on the profit. Gross profit is $140,000. 350 minus 210 is $140,000. This is kind of the top line profit, or the direct profit you make on the items that you produce. Now, the cost of goods sold includes the cost of materials and labor and manufacturing overhead, all associated with making and distributing these products. Now, this is a manufacturing company. It has tangible products. Most of you are service companies. In fact, next week's webinar will be on financial projections. We'll have a service company, a fitness company, in fact, as our example, to show you the contrast or the difference. And a service company typically doesn't have cost of goods sold. All other things equal, that gives a service company an advantage over a product or manufacturing company, and that they don't have that cost. And essentially, their sales equals their gross profit. But here, gross profit is 140 on the original 350. So that's the first cut, kind of the top line profit. Let's take a look at the next category or group of expenses beyond the direct costs of goods sold. They're called operating expenses. And so all the other expenses are grouped into this category to give you an operating profit. That's profit, essentially earnings before income tax, or earnings before tax, pre-tax profit. What are the operating expenses? Typically, there's two categories of them. I like to think of the variable expenses, which are in orange here, and fixed expenses. We have a separate workshop on pricing to maximize your profitability. We do a deeper dive into fixed cost versus variable cost. But essentially, a good way of thinking about it is the variable costs are those associated with selling your product or service, okay? So advertising, obviously, and marketing costs, and your sales force salaries would be associated with selling. Travel and entertainment associated with selling your products are all variable expenses. And then you've got the fixed ones, which essentially, if you think about whether you sell 1,000 products during a given period, or you sell 0, doesn't matter. No matter what your sales are, you're going to have these overhead or fixed costs. You're going to have administrative salaries. That would, you think of your financial, your CFO and your financial people will say their salaries, their administrative staff, they're not associated with marketing or advertising. Okay, so that's a fixed cost. Rent is fixed per month. Utilities, whether you sell any product or not, you're going to have to pay these expenses. These are your fixed expenses. Okay, so those two categories of expenses make up operating expenses. In this case, it's 120,000. So now we're watered down our initial 350 to a gross profit of 140, and now we've reduced that further by 120 in operating expenses. We're down to only $20,000 before taxes. In this case, we have $5,000 in taxes that we have to pay on the $20,000, and that leaves us with a net profit of $15,000. Right. So we can take a quick look at our spreadsheet and look at that a little bit more closely on the P&L tab. So here we've got broken down by month. We've got our P&L worksheet, and we've got, okay, of course, this is a hypothetical, and it's a product company, so we've got to call them widgets. Widgets and widget parts are the two things that they sell. And we can see that the first month, January of 2019, they had 25,000 in sales, and then they bumped that up a little bit and came back down. So that's their sales. And then they have their cost of sales, right, which is raw material cost, labor costs directly associated with those, the development of those products, creation of those products. So the total cost of sales is your $15,000 there, 15, 17, and so forth. That gives you a gross profit by month, right? And the total gross profit is the 140,000 that we saw on the 350 in sales for the total year. Again, income statement is over the flow of an entire year in this case. I've got operating expenses, such as advertising. That would be a variable expense. You've got service charges and card delivery and travel. You've got credit card fees. Depreciation is in here as a part of your P&L statement. So you do want to capture depreciation. There's that $6,000. Remember, out of $60,000 in furniture and equipment and machinery, they lost $6,000 to depreciation, which was spread out at $500 a month, right? You've got insurance, a fixed cost. Here's your loan. Now it's interesting, kind of a nuance of a P&L statement is that you capture the interest only portion of a loan. Remember the loan on the $60,000 loan on the equipment and furniture. They capture the interest on that loan, but not the principal. They separate that out. Okay. Payroll expenses you've got. And again, that would be to the extent that this payroll is administrative staff and not sales, that would be a fixed expense. You've got payroll expenses such as the software, for example, that you use, professional fees. There's your rent. And we'll come back to that in a minute. Essentially, what we'll see is that what the P&L statement shows is it recognizes something like this expense as well as the revenue at a time it occurs, okay, but not necessarily at the time that you either made the payment in cash or received the cash. So in this case, rent of $1,750 in January, okay, is recognized as your rent payment for January. That was the obligation you had, right? And in this case, you did pay it in January, right? But there were other expenses. Let's see if we can find any. I mean, it could be any of the other expenses that you put on if you have terms for some of your expenses where you made a payment on professional fees. Let's just say you pay that by credit card, okay? Well, you recognize it on your P&L statement as having occurred in January because that's when you were billed for it. But if you put it on a credit card, okay, from a cash flow statement, we'll see it when we get to cash flow statements, okay? You didn't actually have that cash outlay until February, right? And that's when your cash flow statement is going to show that January professional fee that you essentially were billed because you didn't pay it from it didn't leave your bank account until February. So that's a difference, a key difference between a P&L statement and a cash flow statement. Same thing on the revenue side. You're going to see that sales of $25,000 were recognized. So you actually made, this company started up at the very end of 2018. Yet the first month of January, they had $25,000 in sales. It's recognized on their P&L statement as having occurred in January, which it did, but we'll see in the cash flow statement that they have 30-day terms, okay, to their customers. And that $25,000 won't be shown or recognized on the cash flow statement until February. Essentially, the cash flow will show a zero in January, because they didn't get that cash from the sales that they made in January until February. So you're going to see these lags on both sides, on the revenue side and on the expense side, between the P&L statement and the cash flow statement. And that's why by the end of the year, you're going to see that their pre-tax profit is $15,000, but their cash flow at the end of the year is not going to be $15,000. It'll be off by a bit. Plus the fact that the income statement has, again, depreciation, which is a non-cash category or line item, and that none of those non-cash items are on the cash flow statement. We'll see as well. So again, these are some reasons why you're going to see a difference between a P&L statement and a cash flow statement. They're very similar, but there are those differences between the two. So there's their P&L statement. Let's go back to the presentation. All right, full size, full screen. So now we know the components. Now here's again, again, the relationship between P&L statement and balance sheet. And I'll use another example to illustrate this. But in this case, we've got a profit of $15,000, which we found here, right? $15,000 after the first full year, January through December 2019. And remember, the balance sheet we took at the last day, 12/31 of 2019, after one full year, and stopped the clock. And we added up the assets and liabilities. Well, that $15,000 in profit was kept or retained earnings within the business, right in the checking account, right? That's an asset. So actually that would be reflected as part of that 55. $55,000 in owner's equity, remember, because that's one of the two components of owner's equity, the profit. If the business spent the $15,000 in profit, right? The owner took the $15,000 and bought a car, right? Then that wouldn't have been retained earnings, and the owner's equity would not be at 55, it'd be at 40. So there's a relationship between the P&L statement and the balance sheet. And that, again, if you think of yourself, you personalize it yourself. Let's just say that you have, let's go back to say $300,000. Well, let's just say you have $100,000 in your personal balance sheet. Your household balance sheet is $100,000. That's your net worth, assets minus liabilities, at the beginning of the year, $100,000. Okay, then during the course of the year, okay, let's just say you have a job and you earn $100,000 gross on your job, or your household does, you and your spouse, $100,000. Okay, but of course during the course of the year you're going to have taxes and expenses and so forth, but you wind up saving $15,000 by the very end of the year. Okay, and that's in your savings account. So you started the year with $100,000 net worth, kind of the owner's equity equivalent to a business, and you wound up keeping $15,000 of the income that you earned during the year in your household. So by the end of the year, your net worth has jumped from $100,000 to $115,000. Okay, works the same. That's how you build your net worth. As a person, that's the way, or as a household, and that's the way a business builds its owner's equity as well, is to retain those profits within the company, and it builds its owner's equity. All right, so that's the relationship between the two, P&L statement and the balance sheet. Last one is the cash flow statement. That's my favorite. I think that's of all of them, that's really kind of the most important one in terms of the solvency of the business. All right. In fact, this shows or reflects actual cash outlays as well as actual cash receipts at the time they occur. So this is another flow like the income statement over a period of time. And we'll see our example is, it'll be monthly, but then again, I will show you a full year's worth of monthly cash flow data. Okay, and this is important because over a third of businesses fail due to lack of cash flow, either up front or on an ongoing basis, not managing their cash flow effectively. And we'll go into that in a little bit more detail a little bit later on. And particularly since and here's the thread to COVID, since we're in a pandemic environment, which is severely impacting our economy and businesses and how they operate, companies' cash flow is so critical to be able to manage and optimize your cash flow. So it's important to really understand it and manage it more effectively now. So we'll take a little bit closer look at the cash flow statement than the other two, because it is so critical. And so essentially what I say here is profitability from your income statement or your P&L statement determines valuation. What I mean by that is that if you were to sell your business over time, typically one way to determine or estimate the value of a business is a multiple of your profits. So it could be a 4 or 5 times multiple of your annual profits might give you a good ballpark value of your business if you were to sell it. Cash flow, on the other hand, determines solvency. That is whether or not you survive, whether your business lives or dies, and that's even more important. You've got your business has to survive, and that's all based on the cash flow. So cash flow statement, all right, again, it deals with only cash transactions, right? And it excludes those those non-cash items such as depreciation, amortization, goodwill, right? So those are out. Nothing but the real thing at the real time that they're realized. And it's important to prepare this on a monthly basis, and over the course of a year is important. And you want to analyze this and revise it quarterly or maybe even monthly, and make adjustments, but mostly use it to be forward-looking and to plan ahead and to project your future cash flow. Okay, and then to essentially to manage your business and your sources of finance. Okay, to be able to accommodate these fluctuations in your future projected cash flows. So it's so important to project, and that's why next week we'll be focusing on projections in that webinar. All right, so here's a typical cash flow curve from startup. So a business starts up. Almost no business that I'm aware of starts out right out of the gate with a profit. They have monthly losses actually, and these cumulative losses can last for months and even over a year or two in some cases, depending on the business. Take a look at Tesla. How about that? Or Amazon too. How many years it took for them to make a profit. Those are extreme examples. But in any case, it will be months at minimum before a business typically breaks even, finally gets to break even cash flow, right? So in the meantime, you're getting a more and more negative cumulative cash flow up to that point until finally you break even, and then you go positive cash flow, hopefully on a sustained basis, and you start to catch up and eventually recoup all of that negative cash flow, and then you're in the clear here, in the black, and in the red over here. So that's typically the cash flow curve. What you want to do is you want to do these projections on a monthly basis as a startup, to project how much the most negative cumulative cash flow is, this bottoming of this curve down here, okay, before you finally get to break even, because you want to quantify that, you want to estimate that accurately in advance before you open your doors the first day of business, because you want to line up sources of capital essentially to cover that period of time when you've got a large cumulative negative cash flow. And you want to line up the right sources to cover those, right? Plus maybe a little cushion as well, because if you don't, you're going to run out of cash, and you won't even make it beyond that point. You could very easily run out of business. Or, if you don't, then you're going to be out of desperation looking to other kind of other sources of cash that are less than optimal to help get you past this cumulative negative cash flow, this bottom part of the curve. So again, another reason why you want to project. You want to project your cash flow. So sources and uses of cash are, all right, so the sources would include cash on hand, of course. Money in the bank is the most liquid source of cash. Might not be the best for every use of cash that you have, but it's a great source, absolutely. Revenue is probably my favorite. Revenue from sales is a great source of cash. Reason for that is if your business is thriving and healthy and has ongoing strong sales, that's a renewed monthly source of cash, right? On an ongoing basis, revenue from sales. It's a reflection of the strength of your business. Then you've got assets to be liquidated. Now, this is not a good example of how to get cash. Again, this is more of out of desperation if you have to sell your assets, just like if you to do that, sell your furniture or your belongings, your jewelry, in order just to make the bills for the month. You don't want to do that or get into that position as a business. That is not one of the better sources of cash. Loan injections can be an excellent and very appropriate source of cash if it's the right type of loan for the right purpose. Owner or investor equity contributions, again, we've got, so the difference between loans, which is a debt source of cash, and equity, which